Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals now. Jyotivardhan Jaipuria, founder and MD of Valentis Advisors, is joining us now. Mr. Jaipuria, good morning. Thank you so much for joining in. Well, you're expecting lower returns to come by and lower earnings growth is expected in FY25 as well. Can you give us a sense of what is the Nifty earnings growth that you're expecting? And Q2, how have you looked at it so far? I know not a lot of results have come out, but do you think this trend could continue going forward as well?
Yeah, so Sonal, I think over the next 2 years, we'll probably end up with a very low double-digit sort of return, maybe 10 to 12% over the next 2 years. In fact, of them, this year is probably going to be a high single-digit return rather than a double-digit return because of the base impact. This quarter earnings, like if you look at a lot of the analyst forecasts which have come, everybody looking at between 5 to 7% sort of growth. So it's going to be a quarter which will be muted in terms of earnings growth. So far, of course, we've seen a very small sprinkling of results, and they've been, like I would say, on the whole, more or less in line with expectation. But, it's the very, very start of the season. So far, there are very few results which have really come out.
So you would be fully invested, Jyoti, because as you've pointed out in your recent note, that we're headed for the 9th consecutive year that the Nifty is given annual returns. Has that even happened before in the past? Shouldn't the law of averages at some point kick in and we see a bit of a correction?
Yeah, Reema, so this has never happened. The 9th year or the 8th year is like a record for us, whether we take the Nifty or we take the sensex also, which has got a longer history. So it's been really, I would say, a very, very smooth market where, you made some returns every year. So then for people, the risk of equity goes away. Because if you don't really see a meaningful negative return, you are like, okay, if I make 10% return or every year I make 5%, then it doesn't matter. So at some point, the law of averages will catch up. I guess, even valuations the way they are, at some point they're signaling that we'll probably have a weakish year for equities. But, frankly, if you think about it, most of us thought this year is the year where we'll not make too much returns in the market. When we started the year, we thought it could be a year of flattish to very low returns. It has turned out to be much, much better than what we thought. So I think partly it's because the economy is doing well, partly because the global markets are doing well. So keep our fingers crossed that bull times continue.
Okay, so tell us which are some of the sectors where you are looking for further correction, where you think there could be growth but valuations are stretched, or something that you think still is reasonable and you can put in some money there?
Sonal, there are lots of things where earnings growth is there, but the valuation are looking stretched. So one thing which we've been negative on, which a lot of other people like, has been the auto segment, where I think especially on the passenger car vehicle, we think growth will be very slow over the next few months. And, you've seen a very good rally in the share price there. Valuations are not cheap. So that's one thing which may struggle to give returns to the investors. The other is a sector which we like a lot, which is the capital goods sector. We've done very well with it because we had picked it up very early in the cycle. There again, valuations are starting to look stretched in some pockets. In fact, I think they're extreme. Like I would say, things like defense and railways, which are the market favorites, there the valuations are very, very extreme, even though the long-term prospects are good. But even within capital goods, we've trimmed some of our position more because we think that at those valuations, the risk return is not that favorable. And so we've continued to be a little negative on it. What we've been nibbling on is actually the banks. So this is like a sector which now everybody loves to hate and nobody really owns it. Valuations, they are looking very cheap. So we've done an exercise where we looked at, let's say a 10-year PE average and the current PEs, or 10-year price to book and current price to book. And there are only two sectors which are actually trading at lower than 10-year averages. One is the banks and the second is the media. So these are the only two sectors trading below. So banks is some space where we've been nibbling a bit. There are going to be NIM pressures over the next 2 quarters, and especially once interest rate cuts start, you'll probably see the first impact of that will be negative on NIMs, and only after like 3-4 quarters NIMs start to increase. So there are negatives, but the valuations are so cheap that at some point, we think we'll make decent money on the banks.
So it's time to accumulate banks through this period of perhaps a little bit of bad news when the stock's correct due to the NIM compression. What about media? Are you buying media because valuations there are also attractive?
So, we actually have a media stock which we bought in the last 3 months. So that's like the first time we bought media in the last 4-5 years. So, in media, like I have a mixed view. The stock we bought is very, very cheap. It's like very, very cash surplus. At the same time, the business is not very promising to me in the sense, there are a lot of avenues opening up. So right from OTT to, the cable TV business is going down because a lot of the youngsters are preferring OTT. So the growth element is probably not very strong, but just the cash flows which we are getting and the free cash flow we have taken a stake in a media company, basically.
All right. Okay. Thank you so much for joining in today with your take on what the markets would look like going forward, especially on the earnings and the valuation front, because it's a lot happening that we are tracking in the markets as well. With that, we'll slip into a short break. But as we do that, CNBC-TV18 celebrates 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policy makers, industry leaders, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. Don't miss your exclusive opportunity to be a part of the conversation that is shaping the future of business and innovation. Reserve your spot today.